But once you are making the big bucks, you're in better shape to be able to really navigate and save money on your taxes. Disclaimer, although I'm getting into some of the details on taxes, I'm not offering tax-related advice at a personal level. So you would want to consult the person who does your taxes to verify whether these are appropriate for your situation. Our learning objectives. Quick intro to the current federal tax code. Tax planning basics, what you need to know prior to filing your tax return for last year, due April 15th of this year. And then some very good tax management strategies for future higher income. So let's look for a moment at the current tax code. You guys are in graduate school, so I don't know that you were paying much attention to the Tax Cut and Jobs Act. It was introduced in 2017 and went into effect in 2018. Made some significant changes to the way federal taxes are calculated and how tax forms are organized. The premise was that the tax return was going to be shrunk to about the size of a postcard, which didn't exactly happen, but it is reorganized in an interesting way. And there were some significant changes. For example, there are new tax brackets. I'm going to show you what they are for 2020 so you understand what a tax bracket is. There are new lower tax rates. The whole idea was to make taxes lower for people who make less income and higher for people who make more income. There were some fabulous breaks for some high income earners, which we won't get into here, but the tax brackets and rates were beneficial to many people. New higher standard deduction amounts were introduced, dramatically higher. We're going to talk about those specifically. And in exchange for those higher standard deduction amounts, they got rid of personal and dependent elections. I don't know if you filled out a W-9 starting a new job anytime in the past couple of years. You will have noticed, particularly last year when they finalized the form to really match the Tax Cut and Jobs Act, that it's not like it used to be. It used to be you could kind of play with how many exemptions you claimed, which made a lot of sense if you had low income and multiple part-time jobs maybe, and you really wanted to take home as big a check as you wanted. You could claim maybe 5 or 6, maybe more dependent exemptions, which would have the effect of reducing the amount of tax withholding on your weekly paycheck. That's gone away. So no longer can you claim multiple exemptions. It's not a thing. Now what you can do on your W-9 is ask them to withhold additional tax, but not less tax. The whole idea for the new tax code is that everybody pays into it what they owe at the time of being paid. So people who used to like to have a lot more withheld and get a big fat refund in April used it as sort of a forced savings program. That doesn't really work anymore. But it's also true that people who didn't pay a lot of taxes and rather paid it on April 15th, that doesn't really work as well either. So it's a pay as you go, and everybody is more or less kept up to speed. If you end up owing taxes, generally under this tax code, it means that you had a non-payroll type of income. So if you did some 1099 work or you got some giant credit of some sort, that will, because it's not given to you after tax, that could cause you to owe taxes at the end of the year. Another big change, you hear a lot of people in the New York metro area and California complaining about this, what's called the SALT cap. SALT stands for state and local income taxes. Part of the big reveal on this new tax code is that a lot of different tax deductions and credits were gotten rid of to simplify the code, and a cap of $10,000 was put on state and local taxes, which means that if you live in the great state or great city of New York City, you're paying income taxes at the city level, the state level, and the federal level. Before this tax code, you could deduct what you paid to New York City and New York State, and the federal government would figure out your tax based on what was left. Now you can only deduct $10,000 of your city, state income taxes and any property taxes you pay to your locality. So big hurt for a lot of people who suddenly saw their ability to take this big tax deduction. It's being fought right now and may be eliminated, probably not for 2021, but we'll see, but maybe by 2022. So that would be a good thing for a lot of people who like to deduct these things, like to itemize their deductions and have those taxes paid recognized on their 1040. Another change was a cap on the deductibility of mortgage interest. It's actually a very high amount, so it doesn't really affect a lot of people. Then in 2019, little tweaks and changes, and this was beneficial to a lot of people. The alternative minimum tax exemption was increased. When that was introduced, the whole idea when Congress passed the alternative minimum tax was to catch people who had high incomes but didn't really pay any federal income taxes. The primary reason that they didn't pay any federal income taxes is that they had a lot of mortgage interest that they could deduct, or they received a lot of income from municipal bond portfolios. Municipal bonds are typically issued by state municipalities, and many of them are considered triple tax-free. Warren Buffett used to be a huge investor in municipal bonds, and it generates what is effectively tax-free income. To catch those people and to have them pay at least a minimum tax, your tax bill is calculated using the AMT rules and the regular way rules. If you owe more under the AMT, that's what you pay. What was happening is that it was never indexed for inflation. So as incomes went up, as mortgage interest deductions went up, it was beginning to catch more middle income taxpayers, and it seemed rather unfair. So now you actually have to make a lot of money to be potentially responsible for paying the alternative minimum tax. So that was a good change to have made. For 2020, and again, it is 2021, but we're interested in 2020 because when we fill out our tax forms before April 15th, we want to be aware of what changed last year that could potentially impact how we fill out our form. Remember that there were many different pandemic-related tax legislation and executive orders issued. We had the CARES Act, which introduced the recovery rebate, the $1,200. If you were married filing jointly, it was $2,400. And each qualifying child under the age of 17, you got credited with $500. A couple of things to know. This was based on income. So there was a phase out. If you made too much money, you didn't get the full $1,200. The other thing that is true is it's called a rebate because it's literally a tax rebate. It's not taxable to you as income for 2020. The other change under the CARES Act, people were allowed to make early withdrawals from their retirement accounts up to an amount of $100,000 if it was in their account. And the 10% penalty for taking that money out prior to age 59 and a half was waived. Additionally, if you tap this money, you had 3 years to pay the income taxes on it. Because remember, anytime you take money out of a retirement account, it's taxed as regular income. So that was beneficial to people who were trying to hold on to businesses or their homes and pay their bills and had no money because they had no job as a result of the pandemic. Income tax required minimum withdrawal affects people who are of retirement age. That was moved back in 2020, and that's permanent. The other great thing is that everybody, if they made charitable contributions, and these are cash contributions, not clothes taken to the Salvation Army, for example, but if you made cash contributions to nonprofits, charities, you could take that as a deduction. And it was an above the line deduction, which I'm about to explain exactly what that means. Okay, so those were some significant changes unique to 2020 in light of what happened to us with the pandemic. Some other new features to know about: we can now e-file amended returns for 2019. So that goes 2 years back and going forward. And this is a big deal, probably more exciting for tax preparers than for regular people. But if you found, for example, that 2019, you made a mistake, you forgot to include some 1099 and you owed more taxes or whatever, or you were eligible for a refund and you never got it together to send in your tax return, you can e-file that now. And that is a much, much simpler process than using the old paper form and attaching all the stubs. The other great new feature is that anybody who wants one can apply for an identity protection PIN. It used to be they only handed these out for people who were actual victims of identity theft. But now, for example, if you're somebody who has had some identity theft challenges, maybe not with your taxes, but you think that your social security number has been compromised in some way, you can apply for the PIN and protect your personal information on your tax form. The first day that any of us can file our form, and obviously if we're getting refunds, we want to file it early, the first day is tomorrow, February 12th. This is unusually late for the IRS. Normally, they're ready to go January 21st. That's the date by which companies have to issue their W-2s and 1099s to all of their paid people, paid employees and independent contractors, so that they can turn around and file their forms. There were so many changes as the result of these pandemic tweaks and updating the forms and all of that, that they needed this extra time. So we can start tomorrow, and our deadline is certainly by April 15th. One of the things that many people do not understand is the actual flow of the IRS 1040 tax form. And so when you hear a CPA or a tax preparer talk about above the line and below the line, most people have no clue what that means. But understanding it is key to a lot of things. And I just want you to walk away with an understanding of what these terms mean, how the form flows, and what levers you can move to lower your tax bill. So above the line, we all start with gross income. That's income from all sources. On our next slide, we're going to talk about all the different things that count as taxable income. So you pull together your W-2s from all your different jobs. Maybe you also have a 1099 for some independent work you've done. Maybe you served on jury duty. You got to keep that pay stub. That's income. You collect all of this stuff. Then you subtract what are called adjustments to income. And it's a specific list of things that we're going to look at that you can use to lower your gross income and come to adjusted gross income. If you walk away with any term from this particular presentation, focus on adjusted gross income, and you'll see why on the next slide. Once you get to adjusted gross income, then we talk about whether to take the standard deduction or whether you should itemize your deductions. So you get to adjusted gross income, you subtract your standard or itemized deductions. Now you get to taxable income. This is where you're going to then look at the tax brackets and figure out how much you owe. Okay, so that is the two-step process of kind of going through the 1040. Now, why do I key in on adjusted gross income? Because so many different federal, state, and city benefits are keyed to that number. And again, this is true for all taxpayers, any age. If you have earned income and you want to make a traditional IRA contribution, save for your retirement, if you have access to an employee or employer retirement savings plan, even if you don't participate, if your company offers a 401k plan or a 403b plan, your ability to deduct your traditional IRA contribution depends on your adjusted gross income. If you make too much, no deduction. It does phase out, so there's a minimum amount, and you can have a partially deductible and then a completely not deductible ability to deduct your IRA contribution. Your ability to make Roth IRA contributions is also subject to adjusted gross income limitations. If you want to deduct student loan interest, that too depends on your AGI. If you want to apply for the earned income tax credit, which means that you are working and have young children and you don't make a lot of money, your eligibility is determined by your AGI. Same thing with Medicaid. Same thing if you are eligible, if you're on the New York State of Health, meaning Obamacare, the New York Exchange for medical insurance, they offer premium rebates dependent upon your AGI. Other income, federal and state income-based benefits, including student lunch, SNAP, housing, FAFSA. That's a big one. Some of you may be using federal student loans for your current education or your prior education, or may use it in the future. Your AGI is a big deal when you're filling out the FAFSA form. And then lastly, which may be of interest to people, the Public Service Loan Forgiveness Program, by which you can, if you work for a 501c3 organization, meaning a nonprofit, or the government, you can enter this program, use an income-based repayment option for your student loans. And if you make 120 payments on time, the balance of your student loans are forgiven tax-free. Your AGI is a big deal, both for qualifying for the income-based repayment options, so that and for keeping your payments low over those 10 years of making payments. Let's turn to what counts as income. And some people are surprised that it's not just what you earn at work, your W-2 earnings after your employer savings plan contributions. So when you are declaring your W-2 earnings, if you contributed to a 403b or 401k, that reduces how much income is included in your tax form. If you receive a 1099 miscellaneous, which is if you've earned more than $600 in a year doing independent contractor work, 1099 div, if you've received taxable dividends from your investment portfolio, 1099 int is for interest. You might get that from your bank. If you earned more than, I think the threshold is $15 in interest. All of that is taxable and needs to be reported on your 1040. Your unemployment insurance, including the $600 per week that people were receiving under COVID, all of that is reportable income. I'm going to show you or explain to you where you report that. Withdrawals from IRAs, 401ks, these are retirement accounts. I mentioned before that that is always taxable income, so that gets counted. Distributions from pensions, Bitcoin. And I will tell you, having sat through a number of continuing education courses with the IRS, they are really digging into Bitcoin as it's being used to pay for services and merchandise online. And if you own it and use it in that fashion, they're looking for you to report your income from those transactions and pay taxes on it. Gains from investment account sales, including your Robinhood account. If you've been an active game stock trader, Taxman has an interest in what you've made. Any online gambling winnings, forgiven debt in excess of $600, jury pay, and the interest earned on your federal tax refund. Now, this is a curious thing. Remember that for last year in 2020, they delayed when your tax return was due. It went from April 15th to July 15th. If you were owed a refund, you were paid interest on that refund and got usually a separate check that was kind of a mystery to most people. Well, that was the reason for it. But remember it, and I hope you held on to the stub, because that refund is taxable because it's interest. Additional income are sort of oddball categories of income that are reported on this separate form. So I mentioned that the goal of the Tax Cut and Jobs Act was to shrink the IRS 1040 to the size of a postcard. Well, it's really 3/4 of a page, a sheet of paper. And to make that happen, they created a Schedule 1 attachment. The top of Schedule 1 is additional income. And so it asks information about taxable refunds, credits, or offsets from state and local income taxes. This is where you're going to put your little refund for the interest you earned on last year's federal tax refund. If you've received alimony, that's taxable income. If you've done any work as a sole proprietor, or maybe you have an LLC and you've got some business income from that little side hustle, you have a Schedule C that you fill out on behalf of this little business, and your net income is what's entered as business income right there on Schedule 1. If you own rental real estate, receive royalties, if you have an S corporation or a trust, that income is reported there. Farm income, same story. Here's where you put your unemployment compensation. Everybody always asks, how do I report this if this is taxable income? It goes on the top of Schedule 1. Other income. If you've, technically, if you've done things like had yard sales or had a side hustle doing babysitting, technically that's income and you would report that here. Second part, the lower part of Schedule 1 are what are called adjustments to income. Here's where all of the things that reduce your income get recorded. So if you make an IRA contribution, and anyone under the age of 50 who's got earned income, meaning you worked to earn money, you can make an IRA contribution into a traditional IRA and deduct up to $6,000. If you're over age 50, you can deduct $7,000. Educator expenses. If you are a teacher, you can deduct up to $250 of your unreimbursed expenses in the classroom. And it was just announced that personal protective equipment, if you spent money on that, this can be included as part of your educator expenses. It's not a lot, but it is a deduction that could be worth $250. If you've made health savings account contributions, those are deducted and reported here. If you're eligible to deduct student loan interest, that's reported here. Penalty on early withdrawal on savings or a CD, self-employed health insurance, contributions to small business retirement plans. These are the allowable adjustments, meaning reductions to your taxable income. Now, staying above the line, which is where we still are, we're trying to adjust our income to get to our adjusted gross income. IRAs are a big opportunity. You have to have earned income, but there's no longer an age limit. It used to be that you couldn't take this deduction if you were, once you reached age 70. Now, since people are working beyond 70, some people, if they're working, they're still allowed to contribute. The other opportunity that I have highlighted are these health savings account contributions. This does not require earned income. So if you are a student and on the New York State of Health Exchange in a bronze plan, you are eligible to open up a health savings account and put away money and save on your taxes. You can make a deduction. So for an individual, you could contribute and deduct $3,550. For a family, $7,100. And it's an additional $1,000 if you're over age 55. You will hear more about this as a planning strategy because it is like opening up an IRA for medical expenses. And the sooner you start, the more you will have. You can invest these accounts, and taking the money out in later years, it comes out tax-free. So that's a huge advantage. You can pay when you get there your Medicare premiums with it. You can pay for your long-term care insurance out of this account. It's very flexible. It's a really interesting opportunity. So look for that opportunity, if not now, when you start working full-time. Now I have a sample, a case study. Tina, taxpayer. She's single. She's age 28. She makes $39,000. She's a Mount Sinai PhD student. She's doing a lot of research, stays very busy. At the end of the year, she collects only one W-2. She doesn't have much time to do anything else between studying and working in the lab. So she's got reportable W-2 earnings of $39,345. She does receive some 1099 interest and 1099 dividend statements from her investment company. She had some sales of Amgen shares and some bank interest. So she reports this as taxable income. Before she decided to go into science and start studying at Mount Sinai, she was in a college band, was very successful. They sold some records and she collects some royalties. She has to report this as income. Usually it's not so much, but this year she got $1,200 for it. So she has gross income of $43,604. She made cash contributions by check to God's Love We Delivered. She was so upset with all the people who were going hungry during the pandemic. She wanted to make sure that she did something to help them out. She also, because her mother leaned on her, made an IRA contribution of $6,000. So her adjusted gross income after those two adjustments, $37,304. So we've done the above the line, and now let's look at below the line. Should she take the standard or itemized deduction? Here's the picture again. We've gotten her to adjusted gross income. Now we got to figure out how much does she get to deduct before we know her taxable income. Well, her situation, she is single. So the standard deduction for a single person in 2020 is $12,400. The itemized deduction limits, I mentioned earlier, $10,000 is the cap on your state and local income taxes or property taxes. Altogether, that's as much as you could deduct. Medical expenses, your medical expenses have to be more than 7.5% of your adjusted gross income. So that's what's called a threshold. Only the amounts that is above that number are deductible. Mortgage interest, you can deduct up to $750,000 if you paid so much mortgage interest. And if you have a mortgage where you pay private mortgage insurance, which means that you bought your property with less than 20% down, that can be deducted. Charitable contributions up to 100% of your adjusted gross income are allowable for 2020. So let's look at her specific situation. So her AGI is 37,304. She lives in a rental apartment, so she doesn't have any mortgage interest to deduct. Her New York City and New York State income taxes taken out of her check came to $2,435 combined. She did have some medical expenses out of pocket this year. She cracked a molar and had to have a crown put in. She twisted her ankle really badly, ended up going for a series of physical therapy sessions and some cortisone shots. So she was out of pocket $5,300. To figure out how much is deductible, we have to figure out 7.5% of her adjusted gross income, which is $2,798. Then we subtract $2,798 from what she spent, and what she could potentially deduct is $2,502. She did make some additional charitable contributions. They added up to $800. So her total eligible itemized deductions only come up to $5,737. So she's going to take the standard deduction. $37,304 minus $12,400. Her taxable income is $24,904. Now, when you hear tax people talking about brackets and marginal tax rates, this is what we're talking about. There are bands of income that are taxed at different rates. So if you really make very, very little money, under $9,875 as a single person, your tax rate's going to be 10%. So from $1 to $9,875, 10%. The next band, $9,876 to $4,125, is taxed at 12%. So what is interesting to know is that under the Tax Cut and Jobs Act, these are the tax brackets. So from 10% all the way up to 37%, and the ranges of income covered by it. They get broader as time goes on. So as you make more money, you stay in the 24% bracket longer than you were in the 22nd. There's a big bulge at the 32, and then it gets really wide at the 35. Your income tax, so, is different from the tax you pay on long-term capital gains. So taxable income from a job, on interest payments, on dividends, they all go through these different tax brackets. If you own a portfolio of stocks, bonds, mutual funds, exchange traded funds, or a house, they are subject to long and short-term capital gains tax rates. So a completely different set of tax brackets. There's a difference between short-term and long-term capital gains, and I'll explain that really quickly. If you own a stock for less than a year and you sell it at a gain because you owned it for less than 1 year and a day before you sold it, that gain is taxed like regular income. So that gets lumped in with these different, 10 through 37 tax brackets. If you own it a year and a day before you sell it, you get to pay long-term capital gains tax, much, much more preferential. So in Tina's situation, her 1099 div from her Charles Schwab brokerage account included $3,000 in a long-term capital gain from selling some shares of Amgen. Did very well. She needed the money. She sold it. She recognizes this gain. The way this works, which is kind of curious, is your capital gains sit at the top of your taxable income. So if her total taxable income is $24,904, take away $3,000, her regular income tax, or her income that is subject to regular income tax, is $21,904. So she stays inside the 12% tax bracket. Her capital gains, when you look up on the right, you see that a single person, if you make less than $40,000, the difference between your taxable income and that $40,000 threshold, all of your capital gains that fit inside that gap are taxed at zero. So given that her taxable income is $21,904, you put in the $3,000, only gets her to $24,904. She doesn't pay a nickel for selling those shares of Amgen. This is true if she also had a portfolio. She could actually do what's called bracket filling and sell more shares if she wanted to. And until she got close to $40,000, she would pay zero for realizing all of those long-term capital gains. It's really an amazing thing about this particular tax code that they allow many people to do this. Now let's do a very quick, and I'm going to say that this is a fairly abbreviated tax calculation for her name should be Tina, not Teresa. That's my typo. My apologies. And I say that it's sort of a quick one because we're only looking at the federal code. We're not talking about New York State or New York City. They have their own tax rates, their own tax brackets. They recognize some of the thresholds that the federal tax code does, but not all of them. Same thing with deductions, et cetera. We're just going to focus on the federal tax code because that's generally the bigger ones that we pay. So her income from 0 to 9,875, that first bracket is taxed at 10%. That means the tax owed $988. The next bracket runs from 9,876 to 440,125, taxed at 12. And remember, she only gets up to 21,904. So she has a modest amount that's taxed at 12%, and that costs her $1,443. She's got no income over 40,000. So she has zero there. She's paying no long-term capital gain tax because she stayed under that 40,000 cap. So her total federal tax bill, $2,431 on her taxable income of $24,904 and gross income of $43,000. So you can see how for people who make modest amounts of money, the tax code is pretty light. This is not, this looks pretty good to pay a modest amount to the federal government for a modest income. Now, she has some tax planning opportunities. If she's got more Amgen shares, she could sell these at a gain and again fill up that $40,000 bracket on long-term capital gains. Obviously, she's doing that now in 2021. So this is tax planning she would do now for the tax return she'll file in 2022. If she owns some shares at a loss, and a good example would be American Airlines, which through the pandemic took a beating, she could sell equal amounts, dollar equal, of Amgen versus American, and even out the gains versus the loss. So for example, if her American shares showed a loss of $100 per share and her Amgen shares had a gain of $100 per share, they would cancel each other out. So if she went over that 40,000 and that was going to be taxed at 15%, she could prevent that by doing this move, which is called tax loss harvesting. If you don't have enough gains if you sell more losers than winners and you've offset all of your gains, you can use this capital loss to offset up to $3,000 of ordinary income. So income from your paycheck, but that's the cap. You can't sell your stock losers and generate a big capital loss and offset anything more. If you have more, you can carry it forward for next year's tax return. So here's a strategy for her. Say that in addition to Amgen, she does own shares of companies that were badly beaten down during the pandemic and have really not turned around, yet, because people are not yet traveling and vacationing like they used to. So if she owns shares in Delta, American, Carnival Cruise Lines, some of the hotel companies, if she has these at a loss, she can sell them and use this to offset sales of stocks that have gained in value. Again, remember, short-term versus long-term. You have to own each of these stocks for a year and a day to realize a long-term capital gain. Otherwise, if you have a short-term capital gain, it's taxed as regular income, so it's not helping you. There is what's called a wash sale rule. The SEC and the IRS are not keen on people selling stocks just to realize tax losses. And what they don't want you to do is have a stock that's gone down in value, sell it, and then go immediately out and rebuy it, kind of proving that you sold it only to take a tax loss. So they impose a 31-day waiting period to avoid what's called a wash sale. If they determine that you did do a wash sale, which could be inadvertent. So for example, people get in trouble with this buying mutual funds in particular. So if you had a mutual fund or an exchange traded fund and it's down for the year and you sell your position or a hunk of your position to realize some capital losses, then you take that money and you turn around and you buy substantially the same fund. Maybe rather than a Charles Schwab fund, you buy the same type of fund at Fidelity or Vanguard. They can disallow it and not recognize your tax deduction. So that's the penalty. Okay. But again, remember that if you have excess capital losses, they can be carried forward and used next year. Here we have another case study. This is somebody further on in his career and making a whole lot more money. So this gentleman, Tony, is age 45. He's single. He's a doctor and a faculty member. He's working. He's got a W-2 that shows $279,450 after contributing 3% into the hospital's 401k plan. He does some outside consulting. He works with some bio companies overseeing research, and he sits on a board of directors for a startup. And he's paid for this and reports $85,600 in this additional income. He's got some taxable investment income. He's got a bunch of bond funds that he's put money in over the years, and these things generate some bond interest and dividends, fully taxable. And so he's got to declare the $25,400 as regular taxable income. So he makes too much money to do an IRA contribution. So his adjusted gross income, he's got none of those other things that he can play with on Schedule 1. His adjusted gross income is $390,450. He's single, so his standard deduction is $12,400, which would give him taxable income of $378,000. That's going to be a much larger tax bill. And this is somebody who should think more proactively about some tax planning moves. Oops. Okay, so this is the way it's going to run. And again, this is simplified because we're only looking at his federal tax bill. He does the same thing, the 10% bracket, same $988 that Tina owed. He's got more money. He fills the entire 12% bracket. So that comes to $3630 in tax. He fills the 22% bracket, adds another $99.88 to his bill. He fills the 24% bracket. There goes $18,666. He gets through the 32nd, that adds 14 grand, and then he still has income. And this is a very wide bracket. You see, it runs from 207,000 to 518. That's taxed at 35%. He's got $170,000 taxed at 35%. That's going to cost him $59,745. So his total federal tax bill for 2020 is going to come to $107,113 on taxable income of $378 and gross income of $398. So you can see that this is progressive. You make more money, you pay more in taxes. And here's your proof. Pretty straightforward example. Now, a little bit more about his situation. He's only been contributing 3% to his employer's 401k plan. Obviously, he could afford to put a lot more away. He never followed up to enroll on his employer's deferred compensation plan. Most employers, and this is true in hospitals, I know Mount Sinai has this, if you make over a certain threshold amount, usually it's 150 to 200, each plan will have its own threshold. You are eligible to participate in a deferred compensation plan. It works very much like a 401k plan. You put money in pre-tax. It has the same contribution limits as a 401k or 403b plan. You can't put everything in there. It's deducted out of your paycheck. You set the percentage you want to go in it, and it goes in and is invested. And generally, the investments available to you are similar to what's in your 401k or 403b plan. So basically, it's a way to defer more of your income and not pay current taxes on it. He's also been debating whether to buy an investment property or a home so he can stop paying rent. And he gives money to charities and some not-for-profit causes that he supports, but he is kind of haphazard and inconsistent. All of these are opportunities for a little bit more proactive tax planning. So let's look at these. If he were to max his 401k contributions, as a 45-year-old, he could put in as much as $26,000 per year. I'm sorry, that's not correct. I changed his age. I made him younger. He could put in $19,500. So let's change his age so we can work with the numbers. Let's call him 55. If you're over age 50, you can put in $26,000 a year. You can match that in your deferred compensation plan. So you could shelter effectively, defer taxes on $52,000 right off the top. So now his W-2 is going to say that he has $346,000 as adjusted gross income. If he were to buy a co-op or condo or house that cost $575,000, he puts down 20%, so he can get a regular conventional mortgage, 30 years at 3%. Mortgage balance starts at $460,000. He's going to have deductible closing costs. Not everything in your house closing, your mortgage closing, is deductible. Some of the things that you pay for get added to your basis in the house, and you get some tax relief when you sell it. But he has deductible closing costs of $4,000 the first year he's there. So say he bought this first day or in January of 2020, he's getting ready to do his tax bill. The mortgage company is going to send him a statement at the end of the year showing how much interest he's paid on his mortgage. That is deductible. His SALT deduction of $10,000. Obviously, he's paid more to the state in income taxes and to the city in income taxes, and he's paid property taxes, but he's only allowed to deduct $10,000. And rather than give out checks sort of one at a time and at the spur of the moment, he says, I want to get organized, and I'm going to put $10,000 into a charitable gift fund. And from that, I will then online send checks to different charities that I want to support. Because he is basically pre-funding all of those individual gifts, he gets to deduct the full $10,000. So at the end of all of this, he has total itemized deductions of $40,428. So he takes itemized deductions from his adjusted gross income, and now his taxable income is only $306,000. So let's see what the difference is going to be in terms of his tax bill. He still blows through all the brackets up to the 35% bracket. But now, rather than having $170,000 of income subject to 35% tax, he's only got 109 in that bracket. And when you do the calculation, rather than have to pay close to $60,000 for that last bit of income, he only has to pay 38. So rather than a total bill to the federal government of 107, he's now owes them only 85. Same taxable income and same gross income, but he's done some tax planning and he's got more write-offs and is able to lower his tax bill. And again, he's still going to owe New York State and New York City, but this is a simple way to understand how effective tax planning can really help you out, particularly as you make more money. Tools, tips, and resources. Most people are paying for a CPA or a tax preparer. I meet so many people who have very, very simple returns and don't make a lot of money and would be eligible for tax, the VITA program, which VITA stands for Volunteer Income Tax Assistance. Anybody who makes less than $57,000 and has a simple return. If you've got a small business, this is not for you, but as graduate students, with W-2 income and maybe a couple of 1099s for bank interest, et cetera, if you're under that income limit, you can call 311 in New York City to get either locations or set up an appointment for an online coaching session with the VITA people. I don't know that they're going to do it in person again this year. They're typically fanned out among libraries, public libraries, and some public agency and city offices, where all of these volunteers show up and help people prepare their tax returns for nothing. And you have to study the tax code and pass an exam before you are given the tax returner code and eligible to volunteer in this particular program. So they tend to be good, effective tax preparers. If that is a hassle, you can also use IRS Free File. Please type into your browser the irs.gov website. Don't Google it. You want to make sure you're on the irs.gov website. You will find a link to Free File. And when you click on that, it opens up a web page that lists all of the tax preparing companies that will allow certain people to file their taxes for free. And here's how it works. It's sort of this goofy menu. You got to read one by one to see if you fit their criteria. TurboTax, if you make under a certain amount of money, they'll let you use their TurboTax free file unless you have any 1099 income from like freelance work. They're not doing freelancers. Others will let you do it if you're under a certain age and a certain income level. So you have to kind of figure out which free program is for you. All of them are online, which means that you just key in the answers to the questions as they come up on the screen. And then most people, particularly if they're due a refund, want to submit it electronically anyway. So it will take you all the way through there. They'll let you print it out so you keep a copy, and it's pretty simple to do. There isn't a huge reason for a lot of people to go to a tax preparer if you have a simple return. If your taxable income, meaning your gross income minus deductions, are less than $40,000, do consider investing in a Roth IRA rather than a traditional IRA. And why do I say that? Because you're in the 12% tax bracket. Your taxes are never going to be lower than they are right now. So you don't really need the tax deduction to get a break on your current income tax. If you put money into a Roth, and anybody under 50 could put in up to $6,000. Yes, you take money out of savings, you don't get a tax deduction now, but your growth in that account, and you should invest it, don't just let it sit there in cash. It grows tax-free, free and compounded until you take it out after age 59 and a half. And when you withdraw it at that time, that's tax-free. So this is a great thing for younger people to do. It still makes sense for certain older people to do this as well if they have a period of low income. You can do what's called a Roth conversion and take a traditional IRA and convert it to a Roth. If you do that, you have a taxable event in many cases. So you pay income tax on the amount that's converted. But the premise is, as the expression goes, pay tax now on the seed, meaning that little investment, but harvest the eventual fruit tax-free. So yes, make an after-tax contribution in hopes that many years from now, your investments will compound and grow and you'll have tax-free money to look forward to. If you have federal student loans, your eligibility for income-based repayment is based on your AGI. And I'm going to foreshadow next week's presentation, which is going to include information on student loans. Participating in your 401k plan or 403b plan is a way to manage back your adjusted gross income. If you're not highly compensated, and if you're applying to an income-based repayment plan, suggest you aren't, you could also do a traditional IRA contribution to really keep your adjusted gross income low and be granted a very low monthly payment for your federal student loans. If you're interested to know more about taxes, I know it's a riveting topic. The New York Public Library offers free educational workshop on this topic and a number of other financial topics. They're held through the Science Industry and Business Library, but you can find them if you go to the website online. So here we are, just about the top of the hour at our 2021 Savings Challenge for this topic. I hope as a result of going through this, you have a better understanding of how the IRS tax form 1040 tax form works. Our second challenge, asking each of you to look through your 2020 tax forms, your W-2, your 1099s, do a quick add up of your income, figure out whether you're a candidate to itemize your deductions or take the standard. Do a quick calculation of what you think your taxable income is. So you get to your adjusted gross income, you take your standard deduction, now you have your taxable income, and figure out the top tax bracket you fall into. Once you know this, ask yourself the question, would a tax-deductible traditional IRA contribution make sense? Do you have need to lower your taxes further? Why or why not? Okay, so I hope that that is an interesting exercise and that you'll do it and share this with Anita, who's keeping tally of all of our participants in the challenge for our book prizes. And now I am happy to take any questions we may have in the chat. So I'll take a peek. Looks like we might have some. All right.
I have a question.
Sure.
With the COVID relief where you can take out money from your retirement, if you forget to pay it within that three-year window, there's a penalty that's applied?
Yes, what they do if you fail to pay it by your deadline is they reimpose the 10%. I believe it's only the unrepaid portion. So if you make your payments as required years 1 and year 2, but year 3, it kind of blows up and you don't have the money. What is still outstanding gets that 10% penalty tax.
Does anybody else have any questions? If not, I'll ask another one.
I was about to say, I don't have any questions, but my financial literacy curve has just increased so much in the last hour.
Great.
So I want to say thank you, because they don't teach this in school, and we need to have this stuff started being taught in schools.
And I totally agree with you. Everybody walks into their first tax return. You know, you come out of school, you get a job, and it's like lambs to slaughter. You have no idea how this all works. And it's gotten a little bit more complicated over time. And so it's good to, you know, walk through it now and understand how tax planning can really benefit you.
Oh yes, I'm really just now. Like I got schooled a lot, and I love it.
Good, good, good. So I see some questions coming in. I'm going to back up and try to answer them. Can you clarify again what is the difference between above the line versus below the line? So above the line, meaning that these are where you have all of your sources of income and all of your adjustments to income, like your IRA, like your small business loss, like your student loan interest that you can deduct. So this reduces the income that will eventually be taxed. So that's one bucket. Below the line, so after you do the adjustments above the line, you get to adjusted gross income. So if you're asking which is preferred, if you're interested in pursuing any kind of state, federal, or city program where they look at your adjusted gross income, you want to make sure that all of your above the line adjustments are as robust as possible. So contribute to that traditional IRA, put money into your health savings account, pay student loan interest, you know, if you have it and can deduct it. If you have a little business that has a loss, that loss is a deduction to your taxable income. So that would lower your AGI. Below the line means now you have your AGI. Do you take the standard deduction or your itemized deductions? And obviously, if you can play both above the line and below the line, because you can itemize and have a number of other additional deductions, you're in the best possible situation. Your tax returns are more complicated, but you have more opportunities to save and pay a lower tax bill. I hope that answered your question. Okay. Another question. I thought the tax brackets applied at each level rather than being cumulative. They're both. And I'm going to take us back to that slide to show you. Let's see if I can. Oops. Okay. So the way this works, so each bracket has a dollar amount, you know, from 0 to 9875, the amount taxed 9875, taxed at 10%. So the tax bill on that amount is 988. So if you make a little bit of money, you know, like Tina, she falls midway in the 12% bracket, taxed at 12%. So she only fills really 1.5 brackets. She's really in less than a 12% marginal or effective tax rate. But for somebody like Tony, who has a lot of income, he keeps creeping up the brackets and he doesn't tap out until midway into the 35% brackets. So that's why he's got that initially that big bill, because he's taxed on $170,000 at 35%, which meant a tax of almost $60,000. You add all of these bracket tax bills together, and you come to $107,000. So filling the brackets, paying the taxes. So it is sort of both. Okay. What are some of the things that we can do in 2021 to prepare for 2022? Okay. Well, one of the things you can do if you are expecting a big change in income this year, or even if you're not, but you realize that you've got a pretty good tax bill, you're paying a lot in taxes, and you are under saving in your 401k or 403b plan, you could increase your contributions to those tax deferred savings plan and lower your tax bill. If you are eligible for the transit program, where you can contribute money, I think it's by payroll deduction, and buy either your parking or your subway metro cards using pre-tax money, that will save you in taxes. With the metro card or the transit pass, if you're in a really low tax bracket, you're only saving that tax amount. So for example, if you're Tina and your taxable income is $21,904, you're saving 12% by paying with pre-tax dollars for your Metro card. You'd have to decide, is it worth it? Will I use it, etc. But the more money you make, so the higher your marginal tax bracket, the more valuable those little programs are. And you should look, if you're a high income earner, look at not just the transit account, but also look at things like flexible spending accounts, which are available for medical expenses, for out-of-pocket medical expenses. It's also available for childcare or even adult care. You can put away money pre-tax to pay for those expenses as well. So a lot of programs that offer tax benefits are worth looking at, the higher the tax bracket you find yourself headed for. And then there's always the IRA. There's an income limit, different for single people versus married filing jointly people. But if you are getting taxed a lot, you could put money into an IRA. And if you're under that income threshold, you could deduct that as well. And I mentioned before the health savings account. Now, one thing I don't believe I did say about the health savings account, you have to be in what's called a high deductible plan to be eligible to open and contribute to the health savings account. If you're in the New York State of Health plan and you're in the bronze plan, that's a high deductible plan. You can actually look online for the definition of a high deductible plan to figure out it's a formula, pretty straightforward. What is the deductible before the insurance kicks in, either for yourself or for family coverage? And if your medical coverage fits within that definition, you should be eligible for an HSA. Okay. Makes a lot of sense if you have the income to cover the deductible. And I know a lot of people, if you do go to the doctor a lot, or if you have young children and you're concerned about this, a high deductible plan might not make sense now. But if you're young and healthy, or if you're married and your kids are older and people are reasonably healthy and you've got money to cover out-of-pocket expenses that might come in, then this HSA can be a nice way to save and reduce your tax bill. I hope that answered your question. Okay. All right. What if you're working as a contractor and the contracting agency does not do any deductibles? You get the full dollar amount. What are some tax tips here? So a couple of thoughts on that. If you have both a W-2 job and a independent contractor job, you're kind of covered. So long as your contracting income is not bigger than your W-2. Even though the tax code is a pay-as-you-go, you're going to owe something at the end of the year, but it might not be you might not get a penalty for not paying as you go. If you're only a contractor, and this is true for a lot of self-employed people, where they have a 1099 consulting gig or whatever, that's their main income, no taxes are withheld, they should be paying quarterly estimated taxes. And the reason they should pay it quarterly, their actual due dates, they're posted on the IRS website. If you have your taxes prepared by somebody, you'll actually get these little tax remittance cards or sheets with the date on it and how much to submit as your estimated payment. The reason to take that seriously is because it's pay as you earn. If you wait till April 15th of next year to pay the taxes on all of that contractor income, not only is it going to be a big tax bill, they're going to charge you a penalty for not paying it as you earned it. The penalty is not huge, but it's annoying, and it's based on how much you owe. So if you ended up owing a lot of money, you could see a few $100s as a penalty for not paying it back when you earned it. My recommendation for people who are in that situation, and I work with a lot of self-employed people, is to set up a system whereby every check you get as an independent contractor, you set aside 22% and put that straight into a special savings account so that you accrue the money to mail in to make your quarterly estimated payment. And the reason to do that, that keeps you straight with the Social Security Administration, keeps you straight with the Medicare that we all kick into, and of course with the IRS. You have to do, and with New York, if you hold 22%, you should have enough money to pay estimated taxes both to the federal government and to New York State. And New York State, just as an aside, I was on a tax class with one of my colleagues, and he mentioned that if you end up paying your taxes late, or you get to April 15th and you just don't have the money to pull it together to pay both your New York State and your federal tax bill, pay New York State first, because they charge like 11% interest and the federal government charges much less. So yes, if you owe money and you don't pay it on time, they do charge you interest as well as a penalty, and New York's kind of mean. Okay. All right. Okay, if I offered tutoring from September through November and was paid through PayPal, less than $504, New York State UIB threshold. What is the total amount which triggers reporting on my taxes? I believe that is $600 that you are required to absolutely affirmatively report. Technically, all income is income, but you may have offsetting expenses since you were self-employed. You were doing this through PayPal. You have expenses that would reduce the amount of this income. So you'd probably be okay if not all of that was reported. But technically speaking, income earned is income reported. Okay. Any other questions?
A question about the loan forgiveness that you spoke about earlier.
Okay.
Do they factor in the amount that is paid, or they just factor in how many times that it's paid on time before they forgive your loan?
So there are 3 steps. So when you go to enter the Public Service Loan Forgiveness Program, you do 2 things more or less at the same time. You have a form that your employer signs. It's an eligibility form, and somebody in payroll signs it and says, yes, this is an eligible employer and this is our employee. This proves that they're a 501c3 and can enter you are therefore eligible for the program. The other thing that has to happen is that your loans have to be of certain types. There's some loans that can't be brought into the public service loan forgiveness program, like some FIFO loans from a long time ago. You can consolidate them and render them eligible. That's a process. It's not that hard. Once you have those two things together and they check you out, they look at your loans, they look at your eligibility form, they accept you into the program. The next step is qualifying for an income-based repayment plan. And a lot of people forget to do this. So I've literally had people paying regular 10-year repayment amounts, and they should have been in an income-based repayment because it makes it so much lower and it qualifies for the forgiveness program. When you're qualifying for income-based repayment plan, they're looking at your adjusted gross income. So again, we know how to get to adjusted gross income. It's looking at all of your sources of income, looking at your adjustments to income. Your 401k contributions will give you a lower AGI. IRA contributions, lower AGI. Health savings account contribution, lower AGI. The lower that AGI, the tinier your monthly payment is going to be set. If you're married, they take that into account, how many dependents. If you live in New York State, there's an adjustment because we live in a high cost state. So you could end up with a really, really, really tiny student loan payment. Every year, they are going to have you certify. And part of it is saying yes, that they can look at your filed tax return. And they're going to make sure, and they're going to look and see, did your income go up? Because a lot of people, your income goes up each year. Your payment amount may be adjusted up. Okay. So I've worked with a number of doctors who've entered the public service loan forgiveness program. Get into it while you're in residency. Yes, you're earning a small income, but you can get yourself through 3, if you go for a specialty, 4 years of lower income because you're still learning, you're still doing this work. And you're most of the way, you're almost halfway through the whole program. And what's going to get harder is once you are a doctor and you're making bigger money, you work for a big hospital system, every year you make another, you move from one pay grade, you continue going on. By the time you're ready to exit the public service loan forgiveness program, your monthly payment amount on your loans will have grown a lot, potentially, over those years. There'll still be a balance to be forgiven, tax-free, which is the benefit for staying in the program. But this is what happens as you start to make more money, as it gets harder and harder to get the benefit of these smaller monthly payments. I hope that made sense.
Yes, thank you.
You're welcome. Okay. All right. I think these are all our questions.
So just want to let everybody know, since there's no more questions being asked, this is a friendly reminder that our next session will be Wednesday.
Yes.
Wednesday is the 17th at 6 o'clock. So I will send out the calendar invite to everybody after this meeting.
Great. Thank you. Thank you all for attending.
Thank you all. And everybody have a wonderful night.
Take care, everyone.
Thank you.